Good afternoon. This is the oil market review for the 20th of January. My name is Angelos Zitis and I will be heading this report. The oil market observed a series of impressive trading sessions in the past days. As WTI prices broke above the most recent highs they reached back in October and elevated to a new multi-year high level. The happening is certainly not to be by chance, and this oil report will be dedicated to explain the most important drivers for oil prices at the moment and their potentiality for future price movement. At the end, we will provide a technical analysis that will assist us with a more complete observation of the market, indicating important levels that may be used in the following sessions. We start first with the oil market data released in the past days, as they may provide some valid understandings of the recent price action. During the past Friday, active US oil rigs jumped from previous 481 to current 492 according to the Baker Hughes. This is an increase of 11 active oil rigs in the past week and is the highest weekly increase since the 15th of October. The notable jump in oil rigs could be evidence of higher demand in the past days. The American Petroleum Institute reported its weekly inventory levels of U.S. crude oil, showing a surplus of 1.4 million barrels. No major reaction was observed by WTI prices upon release. Today, a reading that is anticipated by the market is the Energy Information Administration's weekly crude oil inventories and will be released at 1800 GMT plus 2. Oil traders may have to keep an eye out for this figure, as it can create volatility for WTI and Brent oil prices. In the past days, the OPEC January 2022 report was made public, bringing to light the current views of the well-established oil-producing group. Based on the report, some uncertainty over the spread of the new variant around the world persists, while in 2022, the forecast for world oil demand growth also remains unchanged at 4.2 million barrels per day. In terms of world oil supply, non-OPEC supply growth in 2021 remains unaffected at around 0.7 million barrels per day year on year. Upward revisions in the US and Kazakhstan were offset by downward adjustments to Brazil, Canada, Ecuador, and Norway. With this comment, we understand that world oil supply in terms of non-OPEC countries increased very little, if any. Moreover, OPEC's crude oil demand in 2022 remains unchanged from the previous month to stand at 28.9 million barrels per day, around 1 million barrels per day higher than in 2021. Furthermore, from a geopolitical perspective, some tensions in the Middle East between the Yemen's Houthi group and the United Arab Emirates had been noted in the past days and are an important matter for traders to keep in mind, especially if production is interrupted. In this scenario, we could see temporary strong oil price movement, possibly upwards. On a separate note, according to various sources, Russia is building up troops nearby the Ukraine border, which is attracting major media attention at the moment. Even though great political powers from around the world are getting involved, we believe that if a military action is taken, then oil and natural gas can be affected, possibly sending prices higher. Russia is a great producer of both commodities, oil and gas, and the repercussions of making a military move into Ukraine can impact its availability to the energy market. Finally, from our personal view, oil demand continues to be on the rise, even with the new variant. Despite the fact that more oil is needed, major oil producers from around the world are forced to keep output on the leash, as it is difficult to predict how circumstances on the virus front can play out. For example, according to the EIA, crude oil production in the US was at 11 million barrels per day on the 8th of January 2021, while for the same month in 2022, which is the current January, it averaged at 11.725 million barrels per day. This is a very limited yearly increase in production, yet demand continues to increase. We have progressed much since the pandemic started, thus adjustment in supply may be required at this stage. For now, oil demand continues to drive barrel prices higher. We move now to our technical analysis. Please note this is WTI's 4-hour chart. At the moment, WTI remains in an ascending trend line that has commenced since the 20th of December. The price action for now has stabilized nearby the currently noted S185 support level, which was our previous highest resistance level in the past weeks. As the commodity has not shown signs of stabilization yet, we could assume that some bullish tendencies may continue. Thus, we note higher the R187.45 resistance as a possible target for the buyers. Even higher, we note the round number R290 resistance line, which could enable us to consider even higher grounds like the R393.50 level. If the price action is to correct lower, then the S282.75 could provide some support, while the S380 line can also be reached if a notable correction lower takes place. Please note the RSI indicator below our chart seems stable just below the 70 level, implying some traders may be keeping their buying orders for the time being. That's that, ladies and gentlemen. This report was specifically put together to assist all the traders out there. We hope you get the best out of it. We hope you enjoyed this, and from everyone here at IronFX, wishes for solid trading.